Good morning and welcome to this Wednesday, July 26th edition, Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes as we look at what's going on in the market. Well, it's Fed Day. Clearly, that's kind of a big deal. I think everyone has grown to expect another rate hike today. So look for another 25 basis point rate hike. I think it's going to be the wording that most everyone is looking toward. I think everybody expects that we are going to see a rate hike. So what does the Fed say? Are they done? Are they almost done? Will they say that they're only going to be have one more rate hike and then they're done? That's going to be probably the part that most traders are going to be looking at. I can tell you, unless they really drop a bomb, I think the market's looking past the Fed. I think that's why we've seen the market continuing to go up, even though the Fed has remained, with essentially the same rhetoric that they've had all year long, talking about inflation, and they want to stay ahead of the curve, and they will continue to raise that inflation's their number one fight. All of those things they've been talking about all year, and the market seems to be ignoring it. And I'm not just talking about the stock market, I'm talking about the bond market as well. That 10-year Treasury yield hit a high last fall. We have not gone back above it. So I don't know how else to interpret this except to say the stock market and the bond market both have looked past the Fed and are looking to potentially a stronger economy, one without the threat of further interest rate hikes, maybe even interest rate decreases. And so I mean, overall, I think market looks pretty good still right now. And I'm talking about the big picture, long term. Short term, we've still got some issues. We saw some earnings come out yesterday. Mostly the earnings reactions have been pretty good on both the stocks that have strong relative strength and even the stocks that have had poor relative strength. Maybe haven't been performing as well. We've still seen some pretty good pops. I'll go through some interesting charts with you later of companies that reported either Monday after the close or Tuesday morning. So yesterday was the market reaction. And I was looking through them. And honestly, if I just looked at the market reaction, I couldn't tell you whether it was solid relative strength going in or poor relative strength going in. It seemed like both groups seemed to have pretty good reactions yesterday. So that part I think is interesting as well, that we're seeing the market respond somewhat positively to just about all earnings reports. Even those that gap down, we're seeing a lot of recovery in. But again, I'll go through that in just a bit. Let me go ahead and pull up the recap. We'll talk about what happened yesterday. So the Dow Jones Industrial Average finished up 26, S&P up 13, NASDAQ 100 up 113, mid caps up 5, and small caps down just a fraction, just under 1 point. Transport's down 17. So as I look across the board, clearly the NASDAQ, which had been underperforming, I think throughout options expiration week, we finally start to see that group bounce back a little bit. I don't know if the worst is behind it or not. I would continue to watch this 20-day moving average. If that fails to hold, I think we could have a 50-day test in store. But at that point, if we were to get down to the 50-day, personally for me, it would be an opportunity to maybe think about leverage again on the long side, using something like the QLD, which is 2 times the QQQ, or the TQQQ, which is 3 times the QQQ. But I think it's probably a little premature, at least for me it is, to get back into leverage on the long side. But that 50-day moving average might do it. And the reason I say that, you can see the lower PPO, the higher price action, that is a negative divergence. And my experience tells me when I see these negative divergences, doesn't mean that we're going to go to the 50-day moving average. It doesn't mean that we're going to reset the PPO at the zero line, but it increases the odds, in my view. And so that increased potential for more selling is why I would not be into leverage. I think it's just a little bit too risky. But if we were to get back down closer to that 50-day moving average, I think some of the risk associated with negative divergences would start to dissipate, and that would lead me to maybe become just a little bit more aggressive. Looking across the other major indices, I mean, look at the Dow. The Dow's been straight up, PPO straight up, AD line still strong, S&P very similar, although we do still have a slight negative divergence on the daily chart. The AD line, though, has kind of come down a little bit, even though the price has gone up. Maybe a minor warning sign, but one that I would certainly keep an eye on. Mid caps, not yet breaking out. PPO looks much better there. AD line, okay. Small caps, PPO's broken out. Price action still fine. And the AD line has actually improved quite a bit the last few weeks. Transports, everything looks pretty good. Maybe a little flattening on the PPO. So maybe we could use a little bit of sideways consolidation. We'll see there. Moving on to the sectors, we have materials leading yesterday. That was a big breakout. If you look on an annual chart, that was a really nice breakout. If you go back maybe to a 5-year weekly, you'll see that we still haven't quite made a breakout. But this is very encouraging, what we see here. And that AD line couldn't be much stronger. I mean, it looks like it's just straight up. Technology up a little more than 1%. So it had a pretty good day, bouncing off the 20-day moving average. That's great, which is what it's been doing for the past 3 months. So you might think, well, let's just jump back in. And I would say, okay, except kind of like that NASDAQ 100 up here where I showed you that negative divergence. Same thing on the XLK. Higher prices, lower PPO. I'm okay with it, but I would prefer to see a little bit more short-term selling. Maybe even down to that 50-day moving average, or at least maybe down to, say, 170, which would be, another 4 or 5% on the technology group. That would make me feel a little bit better about being more aggressive on the long side. We may still just go right up. I mean, secular bull markets kind of sometimes just put their head down and just keep powering forward no matter what. But if you're going to stay long, you have to just recognize that there is a little bit more short-term risk in the market. Energy, just like materials making the breakout here, energy making a short-term breakout, now challenging some intermediate term resistance up near 87.5. PPO good, AD line strengthening. I think energy looks pretty good. The only problem I have with energy and materials to a lesser degree is that they tend to do a lot of head fakes. And that makes it real difficult if you're a trader. If you're a short-term trader and you're trying to catch the wave on one of these moves to the upside, I sometimes get whipsawed in these two groups. So I don't do a whole lot of individual stock trading in materials and energy because I personally just don't have a whole lot of success with it. But the groups, I mean, when we look at it using normal technical tools, I can't really argue with what's going on here. Both groups look pretty good to me. Leading the materials, aluminum. Aluminum had a really good day on Tuesday, jumping 5.5%. Semiconductors trying to get rolling again, but the semiconductor chart looks just like the XLK, which just looks just like the NDX. Higher prices, lower PPO, bouncing off the 20-day, but will it last? That's kind of where I am right now with semis. Love the group, but it's had a huge run in 2023, and it wouldn't be a horrible thing to see a 50-day test. Diversified industrials, this group's been very strong the last 2 months. A big reason why we've seen industrials having such a big lift over the same last couple of months. I think this group still looks pretty good, up another 2.6% yesterday. AD line strong. I don't really see anything negative here on the DJUSID. All right, let's move on to the 10-year Treasury yield. So today, we do have new home sales coming out. That'll be out at 10 a.m. The the expectation is for 727,000 units. And that's for June. May was 763,000. So we're actually looking for a drop in new home sales from the prior month. But we are a little bit in the rear view mirror with these numbers because we're getting ready to go into August. Although I guess it would be a little early to have July numbers since we are still in July. But many of these any reports dealing with home construction, home building, tend to lag a bit. This one actually doesn't lag quite as much as some of the others. But watch that. So that news will be out at 10 a.m. And then, of course, the Fed, 2 p.m. I can't tell you what's going to happen after 2 p.m. I wish I could. But typically, we tend to see a lot of whipsaw, both in the bond market and in the stock market. I mean, my gut feeling is if it weren't for negative divergences, I really would be believing that no matter what the Fed says, the market will rally. Obviously, if the Fed says, hey, we don't think we're done and we may have to raise more than next month, that might spook the market a little bit because I think everyone is already anticipating that they're going to say something about maybe raising next month. But looking at the 10-year Treasury yield, this is what I was talking about earlier. See that October high on the 10-year Treasury yield up above 430? Right now, we pulled back yesterday 4.5 basis points. We're at 3.87%. We're down more than 40 basis points from where we were in October. And some folks look at the 10-year Treasury yield and don't understand the difference between what the Fed is doing. In other words, they keep raising. Why isn't the 10-year Treasury yield going up, right? I mean, if the Fed keeps raising, well, the big thing is the Fed raising, that's a short-term rate. So it's tied more to what you're going to see on like a 1-month Treasury or a 3-month Treasury, or the Fed funds. The Fed funds rate is what the Fed raises. And that's what it impacts. The 10-year Treasury yield, though, is different. It's longer term. It's tied more to mortgage rates. Mortgage rates don't necessarily go up just because the Fed is hiking rates. It goes up for different reasons. You have to think about what impacts a long-term bond holding. One of the major things that impacts it is inflation. And so we saw the 10-year Treasury yield go up quite a bit over the course of about a year and a half because of inflation concerns. But when I look at this chart and I see the 10-year Treasury yield 45 basis points below where we were last October, even though the Fed keeps hiking rates, keeps talking about inflation, the story that I'm hearing from these charts is that the bond market doesn't believe inflation is a problem. And so I think we've just kind of got like this normalized rate that's up because our economy has strengthened. I mean, we're not, we've come out of the pandemic, we've come out of the cyclical bear market, and we've continued to keep the jobs numbers strong. Unemployment is relatively low still. And so the economy's not that bad. So take inflation out of the mix, and I think we're going back to a more normal type of 10-year Treasury yield, which historically, if you can get one in the 3 to 4% range, that's nirvana for stocks. A lot of folks really been out of shape because the 10-year Treasury yield was going up so fast. But again, to me, that was loss of perspective because it went down so fast. All we did was went right back up post-pandemic to kind of about where we were before, maybe a little bit higher, but still at a level that shouldn't hinder our economy. And so I think we're still in a sweet spot. I think the economy's picking up. I think the 10-year Treasury yield is low enough where it's not going to hinder growth. And as the inflation fears subside, I think that's just more money that rotates from the bond market potentially back to the stock market. All right, let's see what else we have for today. Well, let's move over and take a look at some of the key indices. I always like to keep you up to date on these. So this is the S&P 500. Let me just grab some water here. So the S&P 500, I said there's still a slight negative divergence, and you can see the PPO just slightly below the prior peak while prices keep going up. We haven't had a center line test, but to be honest, if the S&P 500 makes another breakout and this PPO turns higher, negative divergence is going to be gone. It'll be eliminated. And I always talk about that. When you see a negative divergence, it doesn't mean that we're going to immediately sell off. It doesn't mean that we're going to sell off in time. We could go higher. it's the odds, it's managing risk. When you see a negative divergence, you ought to start thinking, hey, things are maybe just a little bit riskier than they've been. All right. So the S&P, I still think looks good other than that slight negative divergence. We continue to trend higher. I don't know how anyone really can continue to look at the market and see bearish or think bearish thoughts. But, we haven't gone back to an all-time high. Maybe that's the next level folks have to see. And then when we get to all-time high, there'll be something else, I'm sure, that comes up. But as far as I'm concerned, we continue to trend higher. I think things look really bullish for the big picture. NASDAQ 100, this negative divergence is a little bit stronger, easier to see. Higher prices, lower PPO, and notice the PPO is still going down. If we go back to that S&P 500, you can see the PPO is flattened. So if you start strengthening again, this is going to turn up pretty quickly. On the NDX, it's going to be a little bit harder because we've actually had more of a pullback, probably relating to options expiration. But now we're starting to get further and further away from it. I mean, once you start to get to Wednesday after options expiration, I start to lose the connection there. And if you're wondering, well, why would we even have any connection if options expired last Friday? Why would there be any connection this week, right? Well, anybody who exercised their options, if they had calls and they exercise, market makers have to provide the shares. They're still on the hook on the other side of that trade heading into the week after options expiration. Many folks will exercise options because it delays tax impact, the tax impact. If you just sell the option, it's immediately taxable in the current year. If you exercise your option and buy the underlying stock or ETF or whatever it is that you were trading, the cost of the option is added to the basis of the underlying stock. There's no tax consequence of exercising an option into a stock. So that's one reason why folks will exercise. We've had a big move to the upside, and you sell, it's a short-term capital gain. But if you actually have that option on a stock that you don't mind holding for a while, you could then simply buy the underlying stock, hold it for a year, and everything is long-term capital gain. So there are reasons why people, and sometimes people just want to own the stock. It's been doing really well, and they just decide, hey, I'm going to stick with it. So that puts market makers still on the hook the week after options expire. So I just wanted to point that out. Small caps, what's going on there? Well, you can see what's going on there. Let me annotate this. I think it's pretty clear what's going on here. We have overhead resistance at 198, and we just touched it, and we pulled back from it. A breakout above 198 would be really bullish for the IWM, and this is one leveraged ETF. If this pulls back to the 20-day, I'll probably be in the leveraged ETF, probably the TNA, which is the triple IWM. Or if we make a breakout, you see a big candle and a breakout, I have no problems buying leverage on a breakout as well. Probably wouldn't do as much, just in case it does pull back one more time. I can get into the rest of the leverage that I want at a lower price. But I would absolutely be interested in adding some leverage on a breakout. All right. Let's go ahead and move on to the chart of the day. This was an interesting chart of the day. If you like these charts of the day and you go over to Earnings Beats, you can subscribe. You can scroll down and you can subscribe to our EB Digest. It's a free newsletter. Name and email address, hit that subscribe button, and you're in. It's published 3 times a week, Mondays, Wednesdays, and Fridays. So I did one this morning. It focuses on relative strength, earnings gaps, candlesticks, price volume, the moving averages, trend lines, a lot of normal technical tools, PPOs, negative divergences, RSI sometimes, just the mostly typical technical analysis. It might be intermarket relationships. It could be sentiment. There are a lot of different things that I talk about, but I do try to make it educational, similar to the shows, similar to the articles I write over at Stock Charts. It's just another part of giving back to the community. So if you want to check that out, go over to earningsbeats.com. Make sure you subscribe. We'll get you set up. We also have a live trading room that's coming up right after the show, starting at 10 a.m. this morning. That is a members only. If you want to be part of that, click on the no-cost trial. It's a 30-day free trial. We do this every Wednesday. You'll get 4 live trading rooms over the next month for free. Come in, check it out, see if it helps your trading. Today's going to be kind of interesting because it's a Fed day. We got a lot of earnings coming in. What do we do with all that? I'm going to talk a little bit about that later this morning. So if you want to be part of that, make sure you get your no-cost trial started. So today's chart of the day, this was an interesting one, and I really didn't think about it until I was putting together the draft, our model ETF draft, portfolio draft yesterday. So we announced to members all of the ETFs that we're going to own for the next 3 months. We were buying them. We are buying them at the open today. And this one, MOAT, M-O-A-T, this is the Van Eck Vectors Morningstar Wide Moat ETF. When I started looking at the fact that it's outperforming, so here you can see that the ETF's been going up. Down here on the bottom, you can see that it's, on a relative basis, it's basically at a 52-week high relative to the S&P 500. We've owned it since April 19th. And since then, you can see we clearly have outperformed with it. The scooter rank now is at 93 almost. So it's really high in terms of how it performs relative to other ETFs. And when I looked at this, let me read you a couple things on this stock. First of all, it's widely diversified. So TRU, I'll pull this up. TransUnion, this is the largest holding in this moat. And TransUnion is only 2.74%. Now, if you study a lot of ETFs, you know that some of them are really, really highly concentrated in a few big names. This one, the top holding is 2.74%, second 2.71, then 2.6, 2.58, 2.57. You go down the list, the top 10 holdings is about 1/4 of the ETF. So 3/4 of the ETF is from underneath the top 10. This is a widely diversified ETF. So that's point number one. Let me go back and show you the chart again. Point number two, and this one is really amazing. Actually, before I do that, let me show you. Let's go in here, and I want to show you how the sectors have performed over the last 3 months. So you go to sector summary, and you can pull up this period for 3 months. Here is how the groups have performed. Technology, consumer discretionary, and communication services. Those are the 3 best performers. Now you can see that 9 of the 11 are higher, right? But the 3 best are those 3 aggressive sectors. Now let me show you one other thing. We'll go back to the S&P. I want to show you the relative strength of the sectors. And I'm going to show you 3-month performance. And look at the 3-month performance relative to the S&P. So the other chart I showed you showed that 9 out of 11 were higher over the last 3 months. This is only showing 3 because only 3 are beating the S&P 500. 9 are up, but these first 6 in the red, they actually are up for the last 3 months, but they're under what the S&P 500 has done. The reason the S&P 500 has outperformed them is because these 3 sectors have carried the S&P 500 to the upside. You're always going to have sectors that outperform and underperform the S&P because they all make up the S&P. You can't have all 11 outperforming the S&P. There's always going to be some outperforming, some underperforming. The 3 that are outperforming are exactly the 3 we want to outperform. These are the aggressive groups. The market is in a risk-on environment. That's why aggressive growth stocks have been leading us to the upside. That's why the market keeps going higher. Wall Street's pouring into the groups that drive the stock market higher. So keep all of this in mind. Now, let's go back to that moat. And again, remember, technology, consumer discretionary, and communication services, easily the three best performing groups. When you look at the moat, M-O-A-T, let me read you first the representation in the S&P 500 of technology, 26.01%. In moat, technology only represents 21.25%. The best performing group over the last 3 months is technology, and moat is underweighted in technology. That right there, by 5 percentage points, that kind of blew my mind. Consumer discretionary, a little over 10% on the S&P 500. In moat, a little less than 10%. Again, underweighting one of the areas that's outperforming the S&P 500. Communication services, 8.11% in the S&P, and moat, 8.91%. So it's just slightly overweight communication services. But if you add these three up, on the S&P 500, it's 44%, 44 and change. In moat, these three are around 41%. So when you look at this down here and you see over the last 3 months that this ETF has outperformed the S&P 500 while underweighting in the three groups that are leading the S&P 500. I mean, I wouldn't even expect that it would be in the top quarter of ETFs, and yet here it is in the top 10%. Scooter, 93, the Scooter score. So how is it doing it? There's only one explanation. It's not because of one stock. It's not because we have one, it's not because they have a bunch of Meta, and Meta had a great quarter. It's not because of any concentration. It's because of one thing. However they're picking stocks, they're doing a really good job of doing it. They're finding somehow a way to pick a lot of stocks that are not even out in sectors that are outperforming the S&P 500, and they're still beating the S&P 500 with those stocks. That is, in my opinion, when I put all this together, to me, it comes down to the manager. I don't know what the manager or managers of this ETF are doing, but they're really good at what they do. And anyway, this is one of the stocks that we had in our model portfolio last quarter, which helped us outperform the S&P by almost 5 percentage points. And we kept it in the current one. This is one of our 7 ETFs that we went with this quarter. And it's one of our staples because it has outperformed. And it's simply, we have 18% of moat in healthcare, 16% in financials, 15% in industrials. So as money rotates, this fund actually benefited a little bit from the rotation while underweighting the hottest areas. It's pretty phenomenal anyway, I thought. There's no real estate, though, in it, no utilities, and no energy. So those three groups didn't have great quarters, and having zero weighting in those three certainly helped as well. All right, what else? Let's talk about earnings a little bit. So I want to go over some of this. These are the companies that I talked about at our Monday Q2 earnings event. And these were companies that were getting ready to report either Monday evening or Tuesday morning. And I said, okay, these are the ones I like going in as far as they were looking good on a relative strength basis. That I always use that as an indication that they will report better than expected numbers if they have strong relative strength. Whereas if they're weak, I think the chances of them beating are not as good. And I've been tracking the results of these studies that we've been doing for the last 2 quarters. So this will make the 3rd quarter. And it is proving my point. The stocks that we feel really good about going into earnings have a much higher chance of beating estimates than those that we don't like. But there's not the same correlation between those strong relative performers and the market reaction, because sometimes you have a buy on rumor and then you get the sell on the news and the market drops. That stock drops, even though it had a great report. Buy on rumor, sell on news. So it kind of muddies the water a little bit in terms of the reactions. But if they do report good numbers and they do gap down, this is kind of what CDNS did. This is Cadence Design. Now, I don't know if they beat. I still haven't gone back and looked at the numbers, top and bottom line. But assuming they did beat, here would have been a sample or an example of buy on rumor, moving up into earnings, selling on the news, and then potentially recovering afterwards. We see this a lot. So that's CDNS. Let me show you some others. These are all companies that we like the relative strength going into earnings. So we would have expected good numbers coming out from these companies, but let's check out their reactions yesterday. So here's Bro. This is Brown & Brown, gap up. So it actually had a pretty good day yesterday. MEDP, MedPace, gap down, but then rallied strongly. So it came back really nicely. HXL, that one gapped down, came back off of the low, but we did have a tactical breakdown there. SSD, breaking out yesterday. GE, huge day yesterday. Nice rally. We like that one going in. It was a big reaction. Sherwin-Williams, gap up. MCO, this is Moody's, gap down, hit the 20-day right here, and then rallied. Paycar, gap down, rallied back above that 20-day moving average. Spotify, that one looks like a breakdown to me. Not very good reaction there. Pulte Home, a little bit of a gap down, then rallied to a new high. And you can see continuing up this morning. Hub, that one gapped down, continued moving lower. LW, big sell-off there. And PII, sell-off hit the 20-day and back up it comes. Now, those were all stocks that I was looking for good numbers. And again, I don't know what the numbers were, but I just showed you the reactions. Let me show you some on the negative side, and then we're going to wrap up. So these are stocks that didn't look so good. I don't know what their numbers were, but I'm going to show you the reactions. Many of the reactions were pretty good. And maybe it was a sell on the rumor, buy on the news kind of a thing. But let's take a look. ARE went a little bit higher. FFIV, huge gap up, but then a sell-off. Remember, on the long side or on the strong stocks, we saw a lot of gap downs with recoveries. Here, we're getting a gap up with a sell-off, the opposite. And this is kind of worth watching. This is part of our study. I want to see how these stocks do, not just their initial gap reaction, but what do they do over the course of the next week or two after earnings? That's another part of our study, because I think it's part of learning how to trade these stocks better from an earnings perspective. CLF, gap up, continued moving higher there. CATY, getting into a couple of the banks, a gap up. Remember, there was a lot of bad news built into some of these banks. and by the way, let me go back to that one, CATY, because it gapped up, was up for a while, and came back down near the low of the day. So again, one that did sell off. WFSFS, gap up and then a sell off. CADE, kind of flat, maybe down just a little bit. IBTX, gap down and moving up today, actually breaking out again. NXGN, gap up, failure. DHR, gap down and then a move up. Looked like we had a breakout and then back down again. It's a lot of volatility there on Danaher yesterday. MMM, this one actually gapped up and has continued moving up. Dow, false breakout, came back down. AWI, gap up, so far so good. FRME, just two more here. Gap up, or maybe just flat open and then sell off. and then SASR. That one was pretty much just a gap down. So I'm not going to draw any conclusions from one day's earnings. I'll go through and take a look. We actually did almost 200 companies, and I probably just went through maybe 25 with you. So we got a lot more companies that we're going to be looking at. But then when we do our earnings, we go into earnings next quarter, we'll come back and we'll revisit what happened this quarter. And hopefully it'll give us some good information as to what we might expect as we go forward in the market or into the next earnings season. All right, let's take a look at the market. Let's go ahead and wrap this thing up. Market has been open for 5 minutes. We got a little bit of weakness on the NASDAQ on a relative basis. Maybe all of that rotation hasn't quite been wrung out of the NASDAQ. I don't know. Dow is up slightly. Small caps and mid caps still doing pretty well. The VIX hitting 14. So with kind of mixed numbers here, the VIX doing pretty, or at least moving a little bit higher, but still remains way below 16, 17. That's kind of a key level. I think if things were to get rough for a while, we could get to that area. I think a very, very slight upside or a slight chance that we could have upside to 20. I don't think the VIX gets back up there anymore. I really don't. I think 16 is probably the highest I would expect. Not even sure we get there, because while we've been kind of consolidating and seeing a little bit of mixed results, the VIX really hasn't been doing a whole lot. So anyway, that's all I have for today. But 10 o'clock this morning, we are going to be having our live trading room right here. So it's every Wednesday at 10 a.m., usually for 30 to 45 minutes. Try to get done within 45 minutes at the most. But I just talk a lot about managing risk. I try to optimize the strategies in order to manage the risk. And I will provide occasionally some real-time trades. I'm not going to force them. I feel like I kind of forced a couple last time. I'm not going to force them today, especially with the Fed looming at 2 o'clock. But there's a lot of things that we can be talking about preparing for trading. Trading isn't always about hitting the buy and sell button. Trading is about doing your homework and prepping and getting ready, having patience, letting everybody else chase, and knowing when to pounce on a trade. So we're going to be going over all of that starting at 10 a.m. If you want to be part of it, start your no-cost trial. 30 days. You will have to give a credit card. We won't hit your credit card at the end of 30 days without warning you that we're going to hit your credit card. We don't want you to be a member, and especially a paying member, unless you want to be one. So please check that out. As if you're watching this on YouTube, our live stream, please hit that like button, subscribe to our channel, make sure your notifications are turned on. So when we have events on live stream, you'll be notified. We're just here, hopefully trying to help educate and help your financial future. I'd like to think we do have a part in that. But anyhow, that's it for me today. Have a great day, rest of your day. Let's see what the Fed has up its sleeve, and we'll go from there. Happy trading, everybody.